Leveraged ETFs can be one of the most powerful ways to take advantage of a short-term trend in the market, but most traders have no idea how they work, which can be a very costly mistake. In this video, we're going to talk all about these leveraged ETFs. I'm going to talk about how I personally trade them so that hopefully you can make an educated decision on whether or not you want to trade them in the first place. So to get started, what exactly is an ETF and what are leveraged ETFs? An ETF stands for electronically traded fund. And for example, the most commonly traded one and the one that you're probably going to be hearing about the most is going to be SPY. SPY is the ETF for the S&P 500 index because you can't just buy shares of the S&P 500 index. You need either a futures contract, an options contract, or an ETF like SPY in order to actually invest into it. So we can see that SPY pulled back today and closed the day down 1.66%. Now if we take a look at UPRO, for example, UPRO is the 3 times leveraged ETF for SPY. So that means that it's going to move 3 times the amount that SPY does on any given day. If SPY goes up 1%, UPRO is going to go up 3%. And since SPY closed down 1.66% today, UPRO closed down 3 times that amount at 4.98%. So it's a little bit of a double-edged sword trading these leveraged ETFs because when the market is moving higher, you can of course capture a larger percent gain with these leveraged ETFs. But on days like today, you're going to deal with larger percent pullbacks and larger drawdowns as well. But ultimately, that is not the main concern and the main risk that's involved with these leveraged ETFs. That's going to be what is known as volatility drag. And we're going to break that down here in just a moment. But I also want to mention that they've actually kind of recently introduced leveraged ETFs for individual stocks as well. So it's not always going to be an ETF for an entire basket of stocks or an entire sector. We can go and look at PLTU, for example, which is the 2 times leveraged ETF for Palantir stock, or PLTR, which is already a very volatile stock in itself. Another example would be AAPU, which is of course the 2 times leveraged ETF for Apple. You're going to see them for Tesla, you're going to see them for Amazon. Pretty much any big blue chip stock or growth stock, they've now made a 2 times or even 3 times leveraged ETF for you to trade with it. But I do want to mention that, obviously there are tons of risks that are associated with these leveraged ETFs, and it's really important that you are managing your risk with them. You're not treating them necessarily as long-term investments, and you are diversifying with them. I'm not a big fan of these individual leveraged ETFs like AAPU, for example, because you're just investing with leverage into Apple with this type of investment. And, something like SOXL, which is the 3 times leveraged ETF for the semiconductor sector of the market, this at least has a little bit of diversification because it's not just investing, entirely into NVIDIA or entirely into AMD. It's kind of investing in all of those in one and the entire rest of the semiconductor market. So just some things to keep in mind when it comes to buying into these leveraged ETFs. Now, in order to really understand the risks that are involved with these leveraged ETFs that most traders do not realize, I want to take a look here at the 2 charts that we have on the screen, one for QQQ at the top, which is the ETF for the NASDAQ, and then we have at the bottom the 3 times leveraged version of that with the symbol TQQQ. So if we focus on this market sell-off period here that happened in April of this year, we can see that eventually the market did recover and actually started to push back above those previous highs during the week of June 23rd. Now, because these are moving pretty much hand in hand, one of them is just the leveraged version of the other, you would think that TQQQ would break up to new highs right around that same time frame. But we can actually see that TQQQ doesn't get back to those highs until about a month later after QQQ has already broken out to new highs. And that is just one of the aspects of this volatility drag that we're going to break down here in just a moment. So not only did the investors in TQQQ have to hold through a much larger percent pullback and a much larger sell-off, of course, if they're not getting out of their trades and managing their risk quickly, but they also had to hold on to that position for a longer period of time without getting back up to those highs when compared to QQQ. So when we talk about volatility drag, let's just say we have a stock that is starting off at $100 per share, and it happens to have a 10% pullback, taking it down to $90 per share. Well, if there's a 3 times leveraged ETF for that stock, it's going to fall 30% in that same time frame, which would take it, for example, from about $50 down to $35. Now, if the stock happens to recover all the way back up to $100 per share, that would mean that it bounced back about 11% from that $90 pullback. In that same time frame, the 3 times leveraged ETF would bounce 33%, which would only take it back up to $46.55. So in the same time frame, the stock went down 10% and then all the way back up to break even, and the 3 times leveraged ETF fell 30% and then still ended up being at a 7% loss from that initial price of $50. This is volatility drag in action. And that's why when you're trading a leveraged ETF, it's very important to have your timing right and to make sure that you're managing your risk. So that way you're not dealing with these large pullbacks and you're not allowing this volatility drag to affect your position at all. So when it comes to actually buying and trading these leveraged ETFs, it's really important to understand that you shouldn't necessarily be doing your technical analysis on the ETF itself, but you should be doing it on the underlying asset. So for example, something like AAPU, this is again the 2 times leveraged ETF for Apple stock. Because it is the leveraged version of Apple, it's not going to be smart to be looking for levels of support, resistance, or trend lines in AAPU, because AAPU is going to move based on what AAPL or Apple does. So instead, you would want to be looking for those key levels of support, resistance, or trend lines in Apple stock, and then using that to actually find your entries and your exits in the leveraged ETF version. So ultimately, that is really how these leveraged ETFs work, and a lot of people do not realize that volatility drag is going to have such a big effect on their positions in them. They're not meant to be long-term investments, they're just meant for short-term trades, and you really want to make sure that you are timing things properly with them. So hopefully you found some value in this video, and if you did, please make sure to give it a like and subscribe to the channel. And if you want to trade with me in real time, get access to our day trade and our swing trade alerts, our detailed trade plans, our live custom scanner streams, and even our day trade bootcamp and upcoming swing trade bootcamp, all of that can be found in the Market Master group. There's going to be a link down below in the description for you to get signed up. Thanks again for watching. I hope you enjoyed, and good luck with your trading.